Hi everyone, we have a very special video this week. We have Brian Yacktman, President and Chief Investment Officer, and Elliott Savage, Principal and Portfolio Manager here at YCG, and they have given a very detailed presentation on our investment strategy, and we're very excited to share this with you. Welcome to YCG, where we help your capital grow so you can achieve your financial goals. If that's something that interests you, then hit that subscribe button and the bell notification so that you don't miss a thing. I'm Will Kruger, CEO here at YCG, and without further ado, I'd love to hand the time over to Brian and Elliott for their presentation.
Welcome to YCG. We thought it'd be helpful to give an overview of our strategy. Here is our required disclosure page, which you can read in detail later. This presentation is for informational, educational purposes only, and is in no way a solicitation or a recommendation to buy or sell any security mentioned. So to start things off, as introduction, we opened our doors in November 2007, right at the peak of the market. We managed those turbulent waters well for our clients, and as of the date shown, we've grown to over $1 billion in assets under management. We manage separate accounts as well as a mutual fund. We're 100% employee owned by myself, Will Kruger, and Elliott Savage. You can see our bios and the rest of the team on the website. We each have significant amounts invested right alongside our clients. And this is pretty important. Many studies have shown the correlation between the size of a manager's investment and subsequent performance. And surprisingly, half of mutual fund managers, according to a study, have no money in the mutual funds that they manage, and 90% have less than $1 million. And we have all of our liquid assets invested in this strategy. In our opinion, the key to successful investing is to compound capital at high sustainable rates of returns for a very long time. And if you don't have to sell and can keep owning the business, then you also get to compound on top of Uncle Sam's money. And this means that we're very careful about what we choose to own. And as you can see, we're fairly concentrated. We tend to have about 30 holdings or so of what we call true global champions. Now, onto our performance. We have market-beating returns since our inception through the dates shown on this slide. To see more current performance, please contact us or visit our website at www.ycginvestments.com. Now, while the market-beating returns is nice, what also matters is how we got there. And we're very pleased we've been able to achieve these results with very favorable risk statistics, as you can see here.
And of course, the question you should always ask when you see a slide like that is, if you've beaten the market, is it repeatable? And so, when excess returns are achieved, we think they can be categorized into one of three advantages. So investors, may claim an informational or an analytical advantage. And while we'd hope to have those ourselves, those can really be competed away in our view. Behavioral advantages, though, we think are the most enduring because human nature doesn't change over time. And so moving on to the next slide, we kind of think that the average investor is overconfident in his or her ability to get rich quick. And as a result, that causes them to overvalue risky stocks and undervalue businesses that produce high and sustainable returns. And the good thing for our strategy is that, multiple empirical studies corroborate this assertion. And yet the advantage isn't arbitraged away, again, due to that remarkable persistence of human nature. Thus, we like to think about it that you basically get paid a premium to be willing to own boring businesses. Another way to say it is that boring's beautiful.
So to see the same concept in a picture format, here we've plotted forward rate of return versus quality. The black line represents expected returns. So if you invest in high quality, you should in theory anticipate to get low returns in the lower right corner here. However, in practice, empirical studies show you actually tend to end up in the upper right-hand corner. So we like to fish in this area to stack the odds in our favor. However, most investors are hanging out on the far left trying to get rich quickly up here, but they often end up in the lower left corner. So we call this the high quality mispricing, and so we're trying to exploit that.
Okay, so stepping back, superior investment returns come from compounding capital at high rates over long periods of time. Another way to think about it is that we want to own the most efficient use of capital businesses in the world that can sustainably earn the highest returns with the least amount of capital needs. But are they easy to come by? Well, in order to understand that, let's look at a little bit of history. So as you look across time, the story of civilization is that innovation has continued to increase. And through the centuries, this has created abundant wealth. And you can see this in this next slide, where rising per capita income is occurring in countries across the world. And encouragingly, these income gains are actually occurring most rapidly in many of the poorest regions of the world. And on this next slide, you can see that all this income growth is lifting the world out of poverty and creating huge growth in the global middle class and adding literally billions of people over time. And the growth is actually projected to accelerate.
Now, this is all great, but as businesses compete against each other to serve the world, with all this competition comes deflationary pricing. This is most readily seen when looking at technology. We're all familiar with the rapidly declining prices in this sector, but the exponential nature of these declines leads to jaw-dropping charts such as this one here, which shows that 30 to 40 years ago, if you take everything your phone's capable of and look at its initial cost, and then you grow it with inflation, your phone would have cost almost $1 million. But as we know, these functionalities and more are available on a $500 to $1,000 smartphone today. And believe me, you would not have been able to fit this long list of applications into your pocket back then. And that was just to the year 2011. And inflation adjusted today, and that phone would cost you over $1 million. So the thing is, it's not just technology. This deflation's occurring in many other large and important sectors as well. So here you see food is becoming a smaller percentage of our budgets over time. And now here onto commodities. After adjusting for inflation, the price of commodities is declining, which makes sense. There's increased supply from more innovative ways to extract them and decreased demand from better recipes, so we need less of them, or alternatives that make it so we avoid using them altogether. But this upward pressure on supply and a downward pressure on demand leads to a downward trend in pricing over time. And here, the same is true of energy, the resource that literally powers all the other sectors. It too is declining in price over time.
All right. So what do we observe from all this? So number one, global wealth is increasing, and as a result, volume growth opportunities are abundant. But growth alone does not translate to superior returns. And that's because competition and innovation are constantly driving down pricing to the cost of capital in nearly every industry and business. And that wreaks havoc on investor returns. So we look for the extremely rare exceptions to this rule. We look for businesses that possess truly enduring pricing power that allows them to sustainably charge large premiums for their products and services while still growing their volumes at healthy rates over time.
So the natural question is, where do you find this enduring pricing power? Oftentimes, we find dominant networks tend to overcome that deflationary pricing that comes as a result of competition and innovation. Not only do they give you current pricing power, but the ability to even grow pricing because their value grows exponentially as the network grows. To see this graphically, right here, notice with each additional user added to a network, the value does not grow linear, but exponentially. Now, many have tried to capture this formulaically, and regardless of whose law you're following, the point is each new user creates multiple new nodes, and so the value of the network grows exponentially with each new user.
And this is in stark contrast to the old world economies of scale, which you really see predominantly in a manufacturing economy. And here, the name of the game wasn't pricing power. You could be a price taker, but as long as your cost structure was less than your competitors, you could earn superior returns on capital. So really the goal was to be the lowest cost producer, because that's what makes everything more affordable over time. But eventually this can become problematic when things like bureaucracy creep in, which as we know, leads to increasing costs. Or, another thing is that it can be difficult to sustain if others simply out-innovate you and bring their costs down even more.
So again, notice that difference with networks growing over time. The other factor that's helpful is if you're in an industry that's growing at least as fast as GDP, because think of it in the reverse direction. If you're in an industry that's shrinking as a percentage of GDP, your pricing power might eventually bump up against that decline. But if it's maintaining share of GDP or share of our budgets, or even growing faster and gaining share of GDP, it allows this backdrop where you can keep raising your prices as your network value grows.
All right, so to put it all together, we seek to identify global champions, and these are businesses with enduring pricing power and long-term volume growth opportunities. And to recap this super important principle, pricing power is the ability to overcome deflationary pricing that comes from competition and innovation, which then, therefore, allows you to consistently earn high returns. Put another way, if someone were to create an identical competitor, but your business can still charge a large premium and continue growing its volume, then you have something really special. And it's most often found amongst network economics, amongst dominant networks where the value is growing exponentially. But again, if you don't have pricing power, you won't benefit from all that growth, even if you do have a long runway of volume growth, because prices would be driven down to your cost of capital. And this is why we're laser focused on pricing power. And then we want to see the ability to reinvest for as far as the eye can see, which allows us to benefit from the rise of global wealth. And then finally, if you can identify a business that possesses enduring pricing power in an industry that's actually maintaining its share of GDP or even growing its share of GDP over time, then you're essentially indexed to grow at GDP or GDP plus.
All right, so on this slide, essentially what we've done is we've taken a list of our representative holdings and categorized them by the key competitive advantages that we believe enable them to earn high and sustainable returns. So as you can see, for the reasons we mentioned earlier, the vast majority of the companies we own benefit from some type of network effect. And we're going to go quickly through these different categories just so you can get a sense of what we mean by each one.
Okay, so the first category is two-sided network effects. The companies in this category are the ones everyone thinks of when they think of network effects. In each case, they connect buyers and sellers of products and services. So in the case of MasterCard, they connect consumers and merchants. In the case of Alphabet, they connect consumers and advertisers. In the case of Copart, they connect buyers and sellers of totaled cars, and so on. Now, what's so great about these businesses is that not only do they benefit from network economics, but they also benefit from essentially no marginal costs. In other words, they can add new users pretty much completely digitally with little to no human intervention and little need for new physical capital, which means that every incremental person or business added to the network is almost pure profit. And so these two factors, the economics of networks and low variable costs, explain why these businesses earn such incredible returns on capital.
Okay, so the next category is protocol network effects. Microsoft, Adobe, and Intuit, they're classic examples of this type of network effect. As opposed to the two-sided networks above that Elliott just explained, these companies write software that helps people across industries and geographies create, share, and edit various types of data and graphics. Because it's expensive in terms of both money and time to own and operate multiple pieces of software for each use case, this type of software becomes more useful the more people who use it and eventually becomes the industry standard tool. While this dynamic's widely understood in software, we think it's less understood in the case of Moody's and MSCI, both of which also operate protocol networks. In the case of Moody's, it and S&P are the globally accepted industry standards that buyers and sellers use to communicate about the bonds that they trade. In the case of MSCI, it's the globally accepted industry standard that investors and funds use to communicate about and benchmark performance. And just like the two-sided networks above, all these protocol networks require very little incremental capital to add another user, leading to incredible returns on capital for the winners.
So this next category is generally not even considered to be a network effect category, but we think it very clearly is. All these businesses have created global networks of consumers who strongly associate their brands with wealth, status, and culture. And this is called a belief network effect. And just like in the case of other network-driven businesses, the value of the network scales exponentially relative to the size of the network, leading to winner-take-most outcomes. But in the case of luxury goods brand networks, this winner-take-most dynamic doesn't show up in the number of units sold by the company. Rather, it shows up very clearly in the dollar value captured by the brand. And you can see this effect most clearly by looking at the list of the most expensive items ever sold in a given luxury category. So automobiles are a great example. Ferrari accounts for 59% of the dollar value share of the top 100 most expensive automobiles ever sold, 75% of the dollar value share of the top 10 most expensive cars sold, and a whopping 83% of the dollar value share of the top 5 expensive cars sold. In other words, the more clearly the purchase relates to social status signaling as opposed to driving utility, the more clearly Ferrari dominates the value capture. And this general pattern plays out in most other luxury categories, with Hermes, for example, dominating the luxury handbag value capture, Patek dominating the luxury watch category, and Nike and the Jordan brand dominating the luxury sneaker category.
Now, the next category is the traditional consumer staples, and they benefit from a weaker belief network effect, where people tend to associate their brands with traits such as safety and reliability. However, in contrast to the luxury belief networks, which are actually benefiting from our increasingly connected world and the consequent higher payoffs of status signaling, the Procter & Gamble's of the world are actually experiencing headwinds. The internet has lowered distribution and advertising costs for small brands, enabling long tail of niche brands to micro-target and take share from one-size-fits-all brands like Tide. As a result, many of these brands are experiencing more private label competition from Amazon and Costco for the price-conscious consumer, and then more high-end competition for the consumer who's willing to pay more to signal their interest and concern for issues like the environment or local business. That being said, we think many consumers still value them as time-saving information filters for safety and reliability, and we therefore think they'll demonstrate significant pricing power for a long time to come.
The next category is brokerage network effects, which are basically the same as the two-sided network effects like MasterCard and Alphabet, except that they've traditionally been more relationship-oriented businesses and thus require more human capital to grow. However, we think that increasing digitalization will allow their businesses to grow their relationships per broker over time, which will enable them, we think, to experience increasing margins. And examples of this transition occurring in other businesses are things like the Chicago Mercantile Exchange, which used to have a bunch of market makers running around with trading tickets in a trading pit, and also investment brokerages like Merrill Lynch, where a broker would call clients with trading ideas. The stock exchanges are now almost completely digital, and discount brokerages like Schwab have massively accelerated the digital transition in investment brokerages. And we think this digitalization will slowly occur in insurance and commercial real estate brokerages as well.
The next category is data network effects, which we define as a situation where companies in an industry all contribute their data to one centralized compiler, who then provides industry-wide statistics and analytical tools that help each company reduce their risk and increase their return relative to a situation where everyone hoards their data. This arrangement solves a classic prisoner's dilemma problem, and it works as long as the trusted third party, which essentially gains a monopoly, doesn't abuse its position. In the insurance industry, Verisk is the trusted third-party monopoly data provider.
And the last two categories, though they benefit to a small degree from various types of network effects, are much more reliant on switching costs and low-cost production. And for idiosyncratic reasons, such as high regulation that make their industry structures resistant to change, we believe these businesses, despite not being driven, wholly by network effects, can generate high and sustainable returns over time.
Now, scrambled another way, you can see we've tried to construct a portfolio that has many sleeves so that the cash flows aren't completely correlated and is robust against various economic outcomes. So you can see here various industries and various products to protect against technological disruption. Lots of geographic diversification to protect against demographic and political uncertainties. You'll notice most of these are fairly acyclical businesses to protect against macroeconomic uncertainty. And with the banks and the insurance brokerages, we have an interest rate hedge here to help protect against rising rates. Because if rates rise, valuation multiples of most businesses are extremely likely to compress. And there's even diversity among investing styles. We own some stocks that are considered growth, others value, which is not how we think about it. But since others do, it does make it a risk that to be protected against. So ultimately, we hope the portfolio can move forward regardless of the wide array of future outcomes.
Okay, so once you've identified a great business with this enduring pricing power and long-term volume growth opportunities, you then want to protect yourself by aligning yourself with ownership-minded management teams, and also you want to make sure the business isn't over-levered. And so the first thing to talk about is ownership. And on this next slide, you'll notice that here's a study that shows family-owned companies have outperformed non-family-owned companies since 2006. And while family ownership, we don't require it, we do want to make sure that management's incentives are aligned with ours, which helps when they have high insider ownership. This way, they're not caving to pressure to meet expectations quarter to quarter, but actually incentivized to really invest in the business for the long term. Because the reality is, they're reinvesting your cash flows for you, and so you want to make sure they're doing it well. And then the next thing you just want to make sure is that they have a conservative enough capital structure. And this chart shows in dark blue the level of total debt as a percentage of GDP and shows how the rates of defaults in the light blue tend to follow high levels of debt. And the point is there are boom and bust debt cycles, and we want to make sure our businesses will survive and even thrive in a deep recession, avoiding blow-up risk.
And finally, to ensure that we don't overpay, we calculate expected forward rates of return and plot them much like a bond table, where you look at returns versus their risk rating. Or in other words, how wide is the bell curve around these calculated forward expected returns? We just want to feel confident that we can generate attractive returns from the price we're going to buy. Now, over long periods of time, stock performance should actually approximate the underlying returns generated by the business. But there could be a tailwind or a headwind caused by changes in valuation. But I want to point out that as time passes, this headwind or tailwind gets amortized over many, many years, and so it becomes less impactful. And so this is why we are so laser focused on the qualitative aspect of things, because it's the compounding happening under the hood that matters and how enduring that compounding is. I mean, look, calculating valuation, that's the easy part. If the quantitative side made you rich, there'd be a whole host of accountants and mathematicians as billionaires. Now, the second point after we've calculated forward rates of return, we've already mentioned the high quality business mispricing, where we focus on high quality, which is nice because we believe that they tend to be perpetually undervalued relative to their dominance and predictability with their strong growing cash flows. And then there's another mispricing that stems from the short-term nature of investors, the market timing mispricing.
So the stock market is driven by economic growth, and probably the most basic, most followed statistic is GDP. And in this graph, the red line is the prediction, the blue line is the actual outcome. And what's clear is professional forecasters who do this for a living are almost always wrong. So if they can't get this first derivative right, then how do investors expect to actually accurately time the second derivative, which is the movement of stock prices? So you really just can't time the market. And if you want to try to time it, hopefully this next slide will give you pause. The evidence is pretty clear that on average, humans can't time it. As you can see in this chart, because of constant investor attempts at market timing due to their fear and loss aversion or due to greed, impatience, and overconfidence, there's a large gap between the annualized return of what they could have gotten had they sat still and the average stock fund investor. And because of this, we don't want to have the overconfidence that we can somehow time it when nobody else can consistently do it. And I would note that the penalty adds up big time. Over this time period, even though they only got half the returns, they ended up with 1/4 of the amount of money. But it's not just the overall market that investors can't time. It's also individual stocks that investors believe they can trade skillfully enough to avoid both the short-term pain that a business is currently experiencing or may experience, but then still be able to participate in the upside once the problems are resolved. And so the best opportunities, in our view, are businesses with favorable long-term economics and predictability, but where the market is gloomy on those businesses in the short run. And so it's absolute music to our ears when we hear, that business has an incredible future, but it's dead money right now. So again, we believe it's not only a flaw to try and time the general market, but also to try and time an individual stock based on macroeconomic beliefs or temporary operational issues. And that's not to say buy any stock at any price, of course, but you really do want to make sure that the price you're paying is one that is believed to provide satisfactory returns from that entry point.
So now let's turn to the value of low turnover. By not selling, we can compound on Uncle Sam's money. So once we accept we can't time the market, your focus turns to identifying resilient and superior businesses you hope to own for a lifetime. To illustrate how advantageous this can potentially become, consider this example. So in this example, both portfolios are growing at 10%, but in patient Paul's case, he holds it for 30 years and pays taxes once at long-term rates when he sells. In Trigger Tom's case, he's selling each year at short-term rates. Now, Trigger Tom, after you run the numbers, he needs to earn 17% pre-tax to get the same outcome as patient Paul. Now, even if Tom paid the same tax rate, it's 11.5% pre-tax to break even. And trust me, that 1.5% adds up huge over a lifetime of investing. So whenever you go to sell, keep in mind, you have to make up a lot of ground to not only cover the tax bill, but to make up for the fact that you can no longer compound on Uncle Sam's money. Once you pay it, it's gone. And so taxes really do make a huge difference.
So to bring it all home, we believe the best recipe for success is to invest in global champions with enduring pricing power and long-term volume growth opportunities. You want to make sure to protect yourself by being aligned with ownership-minded management teams, and you want to watch out for aggressive capital structures to avoid blow-up risk. So all investing really comes down to what you buy and then what you pay for it. You want to not overpay by making sure your entry point is priced to produce attractive returns. And we believe you stack the odds in your favor if you fish in the pond of high-quality businesses where we believe they're often perpetually undervalued. And then also beware that you don't fall for the trap of believing you can successfully time the market or individual stocks. If they look attractive here, then we think it makes sense to grab a piece rather than potentially regret not compounding in a superior business for years to come. And finally, wait patiently and compound on top of Uncle Sam's capital by hopefully being able to hold your superior businesses for the long haul. As the saying goes, if you've done your job well, the time to sell is never. But of course, the market may provide better opportunities or the business dynamics may change, so the portfolio is always evolving.
We think that by designing and faithfully following this strategy, we put ourselves and our clients in a great position to compound our wealth for decades to come. Thank you for your interest. If you want to learn more, feel free to visit our website, www.ycginvestments.com, where we have much more information for you to peruse. And if you have any questions, don't hesitate to call.
Wow, great presentation, Brian and Elliott. Thank you so much. And thanks everyone for listening in. Leave your comments below. Check out our other videos and we'll see you next time.